You're listening to AI Prism from Seoul Economic Daily.
It's Thursday, May 7. I'd like to share some thoughts about retail investors. Imagine walking into a casino and the house tells you, well, go ahead and bet big, and if you lose, we'll cover the first 20%.
Right, you just see a complete stampede to the tables.
Exactly. And, keep that scenario in your back pocket because that is basically what's being engineered in the Korean stock market right now. The KOSPI just crossed 7,000. It's up 75.2% this year alone.
You have a massive rally.
Right, and in a single session, foreign investors bought 3.13 trillion won, which is about 2.2 billion US dollars. The total market cap just hit 6,058 trillion won, or roughly $4.3 trillion.
It's a historic flood of capital. I mean, truly unprecedented.
Yeah.
And for a lot of foreign retail investors tuning in, a huge chunk of that exposure flows right through EWY.
That's the dominant ETF for non-residents.
Right, exactly. But you really have to look under the hood here. EWY is, well, it's basically a seesaw. Sitting on one end are just two semiconductor giants, Samsung Electronics and SK Hynix. They actually make up over 30% of the entire fund.
Wow. So if those two chip makers stumble, the whole ETF flips. It doesn't even matter what the other 70% of the market is doing.
Precisely. And what's compounding this concentration risk right now are omnibus accounts.
Oh, right. The new regulatory system.
Yeah, they allow non-resident foreign investors to trade Korean stocks directly through their brokers without all the old bureaucratic red tape. So when you remove that friction during a massive tech boom, you just get this frictionless, concentrated rush of foreign retail money straight into the market's heaviest hitters.
It's incredible momentum, but I mean, this rally feels like driving a sports car at top speed. It's exhilarating, but you really want to check the dashboard.
For sure. And the dashboard is definitely flashing some warning lights.
Right, like the Buffett Indicator, which compares market cap to GDP. It's flashing red at 256.56%. That's actually hotter than the U.S. market right now.
And you're seeing that underlying anxiety show up in the data in a really unusual way.
Mm-hmm.
If you look at the VKOSPI, that's Korea's fear index. Normally when stocks surge, fear drops. But the fear index just spiked 7.52% to 60.07.
Wait, really? The market is up, but fear is spiking.
Yeah. And to understand why, you have to look at a concept called BIT2.
That's the Korean term for leveraged retail trading, buying with borrowed money.
Exactly. Because these traders are highly leveraged, a tiny, say, 5% market dip could completely wipe them out. So they are terrified of a sudden pullback.
Ah, so they're buying downside protection.
Right. Essentially insurance against a crash, even while they ride the wave up. It's like Life Asset Management CEO Kang Dae-kwon advised. He said in an environment like this, it's crucial to stick close to market leaders rather than just chasing FOMO.
Hold on, though. I have to challenge that logic for a second. If retail investors are secretly terrified and actively buying insurance, why is gold absolutely tanking?
It's a great question.
I mean, gold on the Korean exchange has dropped 20% down to 217,051, or about $150 a gram. And the global spot price is down to $4,568.50. If fear is rising, shouldn't gold, like the ultimate safe haven, be surging?
It is a bit of a contradiction, but you have to zoom out to the broader macro weather. Right now, Brent crude oil is up to $109.87, and the U.S. dollar index is incredibly strong, sitting at 98.07.
Okay, so a strong dollar makes gold more expensive.
Exactly. When you have a dominant dollar paired with high global interest rates, holding a non-yielding asset like gold, which pays you zero interest, suddenly becomes a very expensive luxury.
Ah, so the traditional safe haven reflex is just being crushed by high rates.
Yeah, those macro headwinds are entirely overriding the localized fear, which is why Korean gold ETFs have just sunk to the absolute bottom of commodity rankings.
Which actually brings us right back to that casino scenario from earlier. Alternative assets are struggling, the equity market is top-heavy, and yet the Korean government is preparing to pour even more fuel on the fire.
Oh, you mean the National Participation Growth Fund?
Exactly. Opening May 22. It's basically a tax-advantaged pipeline straight into tech. The size of the fund is 600 billion won, which is about $430 million.
The mechanics of this fund are fascinating. It's designed explicitly to pull domestic retail capital into the market. Individuals can contribute up to 100 million won, about $71,000 annually. They get up to a 40% income deduction.
But here's the kicker, like you mentioned at the start. The government literally absorbs the first 20% of any losses.
Which is wild. It creates incredible moral hazard. If the government is your financial safety net, you're obviously going to take bigger risks. It structurally engineers FOMO.
Right.
And crucially, 60% of that fund must target AI, chips, and biotech. Think about the implications of that.
You already have billions in foreign capital flowing into EWY, which is heavily concentrated in chip makers. Now, this domestic fund is pumping hundreds of millions more directly into those exact same sectors.
Without a doubt, it just amplifies that concentration risk we talked about. So the final provocative thought I'd leave you with is whether underlying corporate earnings can actually justify this massive dual injection of retail and policy capital.
It's a huge question.
Yeah, you really need to keep an eye on the Bank of Korea for any rate hikes, and absolutely watch Samsung's Q2 earnings in July. That will really tell us if the fundamentals hold up.
That's today's AI Prism, Retail Investors. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI Prism is a Juan Ifrey award-winning series. We'll be back tomorrow.
You've been listening to AI Prism from Seoul Economic Daily.